For anyone who cares about the world of economics, the term the subprime mortgage crisis is an all too familiar term to anyone who cares about the economy. Since 2007, it has appeared frequently in the media. It has been in the media a lot since 2007. The subprime mortgage crisis has plunged the powerful US economy into a slowdown and even an economic crisis. The subprime mortgage crisis has put the powerful US economy in a situation of slowing growth and even economic crisis. In today's globalized economy, the change of face in the US economy has affected the whole situation. The US economy is in crisis, and so are the economies of many other countries around the world. In China, the subprime crisis has also had a significant impact in terms of economic downturn, inflation and the plunge of the stock market. In China, the subprime crisis has also had a great impact, such as the economic downturn, inflation and the plunge of the stock market, all of which are related to the subprime crisis. So, what is the subprime crisis? The subprime crisis is known as the subprime mortgage crisis. The subprime mortgage crisis is a crisis that occurred in the United States as a result of the subprime lending crisis is a crisis that occurred in the United States when investment funds were forced to shut down due to the failure of subprime mortgage lenders. The subprime lending crisis. The subprime mortgage crisis caused the global financial markets, including the US, EU, Japan and other major financial markets, including the US, EU and Japan, were all affected by it. In the US, there are 3 levels of mortgage lending. The first level is the prime. The first level is the prime market, which caters to prime customers with a credit score of 660 or above. The first level is the prime market, which is for prime customers with a credit score of 660 or above and offers mainly traditional 15-30-year fixed-rate mortgages. The third tier is the subprime market, which is for customers with a credit score of 660 or above. The third tier is the subprime market, which is for customers with credit scores below 620 and no proof of income. The third tier is the subprime market, which targets people with credit scores below 620, no proof of income and high levels of debt. It is mainly for short-term loans of 3-7 years. The second tier is the alternative A, Alt-A market. The second level is the Alt-A mortgage market, which offers loans in between the first two. The second tier is the Alt-A mortgage market, which offers loans in between the first two. The subprime crisis was caused by problems in the third tier of the subprime market. The subprime mortgage crisis was caused by problems in the third tier of the subprime market. The subprime market is for people with no proof of income and high levels of debt. The subprime market is for people with no proof of income and high levels of debt, where borrowers can purchase a home without no proof of funds is required. On the face of it, it appears that the lending banks are doing a good deed by enabling those on low incomes to have a home to live in. In fact, we must not forget that any company is profit-driven and banks are no exception. These banks are offering no money loans, 3, 5 and 7-year adjustable rate loans, optional adjustable rate loans and many other loans. These loans are available in a variety of forms. The common feature of all these loans is that during the first few years of repayment, in the first few years, the monthly mortgage payment is low and fixed, but after a certain period of time, the repayment pressure suddenly increases. The dangers of doing so are obvious. The dangers of this are obvious. However, because banks have extremely strong expectations of rising asset prices and the profit margins for doing so are large, it is risked a great deal by lending to low-income people. After lending to low-income households, the banks themselves take the risk of transferring the risk and netting the money as quickly as possible. The bank itself, in order to transfer the risk as well as to net the funds as quickly as possible, securitize the subprime loans on the basis of housing mortgages. The securitization of subprime loans, which are issued as bonds, is known as subordinated debt, MBS. These loans are issued as bonds, known as subordinated debt, MBS. Accordingly, these subprime bonds carry higher interest rates than ordinary bonds. The interest rates on these subprime bonds are higher than those on ordinary bonds. As a result of the high interest rates, many many international investment institutions, including investment banks and hedge funds. Many international investment institutions, including investment banks and hedge funds, have bought subprime bonds because of the high interest rates. The investment banks were even more innovative, re-securitizing subordinated debt and designing subprime mortgage securities, and design subordinated collateralized securities, CDOs, which were sold to insurance companies and hedge funds around the world. Insurance companies and hedge funds around the world. The insurance companies and hedge funds then resold these subprime mortgage-backed securities, and, by the end, the risk had spread to global financial institutions. If house prices can continue to rise, such a chain of interest is able to remain normal. However, there is never an asset price that just goes up and never comes down. When the economy goes into stagflation and inflation is rife, a fall in asset prices cannot be. When the economy enters stagflation and inflation becomes widespread, a fall in asset prices cannot be avoided. From 2006 onwards, the US housing market began to decline. The dominoes of subprime mortgages collapsed as house prices began to fall. The domino of subprime mortgages collapsed, with countless families unable to repay their loans, and a large number of defaulted properties being repossessed by banks and auctioned off, resulting in huge losses for the lending banks. The banks repossessed a large number of defaulted properties and auctioned them off, resulting in huge losses for the lending banks, as well as for the investment banks. Investment banks were not immune, with prominent investment banks such as Citi, Merrill Lynch, UBS and Morgan Stanley, Citibank, Merrill Lynch, UBS, Morgan Stanley and other prominent investment banks also incurred huge losses. This was the subprime crisis that swept the world. As China's economy and the world economy become more and more closely linked, the impact of the subprime crisis on China's economy has become more and more significant. The impact of the subprime crisis on the Chinese economy has been significant. Although the scale of Chinese financial institutions' holdings of US subprime financial products is limited, the indirect impact of the subprime crisis cannot be ignored. The indirect effects of the crisis cannot be ignored. The outbreak of the subprime crisis changed the risk. The outbreak of the subprime mortgage crisis has changed the risk preferences of global investors, which has driven the global overvaluation of financial products and increased the volatility of financial markets. Volatility in financial markets. Finally, the depreciation of the US dollar has pushed up global energy and primary commodity prices. This will be reflected in an increase in the PPI.